The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawkbox this Tuesday morning. A stunningly busy day of CEOs, CFOs and the like on this show. Anyway, these are your headlines. So Standard Chartered announces its largest ever share buyback as it posts a 5% rise in first half pre-tax profit. The CFO, Diego De Giorgi, will join us in a few moments, first on CNBC. In terms of equity markets, Asia coming under pressure as the Bank of Japan begins its two-day meeting with a rate hike on the table, whilst the Federal Reserve kicks off its own meeting later today.
ARM shares drop more than 5% as HSBC warns of short-term earnings downside. It's on a weaker than expected AI outlook. And Tesla shares, well, that's driven higher after Morgan Stanley names the EV maker as its top pick in the US auto sector.
Right, let's get to our top story. Standard Chartered has unveiled its largest ever buyback at $1.5 billion. This after the lender posted a 5% rise in first half pre-tax profit, coming in at just under $3.5 billion, beating analysts' estimates. Shares, as you can see, in Hong Kong listing trading currently up 2.7%. Well, I'm delighted to welcome to the show, I think for the first time, Diego De Giorgi, who is the Group CFO at Standard Chartered. Very nice to see you, sir.
Thank you for having me.
Well, why don't you just talk us through the numbers? I mean, the first half reported profits coming in at $3.5 billion. Ordinary dividend up 50% to 9 cents per share. We've already mentioned in the headlines the extra buyback as well. Just dig into the weeds for us.
Sure. So look, a story of strength across the board, really. Top line growth of 13% for the first half. Profit before taxes up 25% in the same time. Our wealth management business has really been firing on all cylinders, 25% up in the first half, a record for the period, and our banking business up 14% during the same period. Of course, that strength gives us confidence for the rest of the year. We've raised the revenue guidance for 2024, and as you've mentioned at the beginning, we've announced our largest ever share buyback of $1.5 billion, coming on the heels of a previous $1 billion share buyback that we announced at the beginning of this year, which gives you a sense that really the strategy is working. We can invest in our business to drive revenue growth and at the same time return capital to our shareholders.
Why? You're a big fan of the show and you've watched it for many years. I know that. You've already told us. So thank you for that. But I'm not a huge fan of buybacks when shares are doing absolutely fine. September 2020, you were trading at 336. You're now trading at 726. I think that's the London listing. That's pence per share. Yep. Why do you need a buyback when your shares have more than doubled in the last 4 years?
Because we can manage both sides of the equation, really. Our capital allocation process goes by the way of first investing in our business, making sure that we drive revenue growth that is quite extraordinary for a bank. 13% in the first half is a number that many banks would aspire to. But at the same time, we hear our shareholders, and even though our share price has appreciated, as you kindly notice, there is still way to go, and our shareholders appreciate the return on capital.
Is it the case, actually, that despite what I just said about the share price, I did pick, obviously, the low of the last 5 years, the fact of the matter is your bank, along with a lot of other non-US banks, just trade at a significant discount to book. I think you're about a 0.5 price to book, 0.49 last time I looked as well. Why is that over? And it doesn't just seem to be at the moment, it doesn't just seem to be cyclically, it seems to be structurally that a lot of banks outside the US, the market just doesn't believe your price to book. So or doesn't believe your book value, I should say.
So that depends a little bit on the times of the cycle. There are times of the cycle where that is definitely the explanation. People think higher loan impairments coming up. It's definitely not the case right now. You've seen it in the past week on the show, and I'm sure you will continue to see it this week as others come to report that the loan impairment cycle is particularly benevolent, I would say. Regulation has been mentioned many times as one of the issues, but it's a bit simplistic. Ultimately, what shareholders want is sustainably higher return on tangible equity delivered consistently. And the banking industry right now is in that phase. It's not always been there.
I'm sorry, I'm going to butt in again because you keep piquing my interest in what you're saying. So that's great. You talk about return on tangible equity. You're around about 10% now. You want to get to 12% as well. The best in Europe trade significantly higher than that. How do we? Is it just because the markets they're in? Are you in the tougher markets? I mean, if I look at the best in class, I'm looking at a 16 to 18% ROTE.
Very, very different business models. As you say, not so much the markets. I mean, we have the benefit of operating in some of the world's most vibrant markets in terms of growth, right? I mean, that is clearly exciting, and it's at the heart of the delivery of the results that we have delivered, including the ones that we just reported. But it's really a matter of what type of business model you are running. Ours is on the up and up. We have been increasing our return on tangible equity by 100 basis points per annum. We continue to see that. A lot of it is our hard work, a little bit is the strength of the markets we operate in.
Let's talk about China. I mean, you've been able to grow profits quite significantly in that region, particularly over the last 2 years. What's the goal then out of that region, considering as well the state of the economy there that isn't necessarily growing as quickly as some of the other places?
So look, China is a story of a slow exit from a cyclical slowdown. And you've seen with the announcements during the course of last week, with the announcements following the 60 points following the third plenum. You've seen it with the concerted action of the PBOC, the Central Bank of China, in cutting interest rates by 10 bips, reducing the rate of lending by 20 bips, and injecting liquidity into the system, that the government is getting a stronger sense of urgency in terms of coming to the help of the economy. That's really what we see on the ground. We see weak consumer demand combined with strong manufacturing expansion and even stronger export activity, which is really what our business benefits the most from. We've been frequent, not me, but we've been frequent guests on this on Squawk Box, and you know that our business in China benefits very strongly from the flows in and out of China. More than 2/3 of what we make depend on that.
But as you connect consumers to and from China, I mean, a lot of the demand out of China isn't necessarily the same as it was, especially pre-pandemic. How do you then mitigate the two right now in this tough environment?
Sure. Look, the truth is that the flows are still strong. It's just that the direction has changed.
Yeah.
The direction that used to be a direction US to China and China to US has now completely been moving towards the global south. And it's China to Singapore, China to ASEAN, China to India, and increasingly China to the Middle East. That plays strongly to us because we exist at both ends of those trades. And in a world where trade of goods, services, or of flows of investment, where that world is fragmenting, that actually is to the benefit of a bank like us that can provide global products but local in-depth knowledge.
Okay, let's talk about your Fit for Growth strategy. I mean, there you still plan to save, $1.5 billion as well over the next 3 years. Does that mean there are a few roles that might go missing?
So look, Fit for Growth is a very important transformation event for the bank. What it is, it's a way of making the bank a better place to work for our colleagues and a better place to do business for our clients. We will realize $1.5 billion of efficiencies, and we will reinvest a considerable portion of that into the growth areas of our bank, which are the cross-border corporate and investment bank and our wealth management that is particularly focused on affluent customers. Could employment levels be lower at the end of a program like that in a world where AI and technology and developments are happening? Possibly, but it's not really the way that we think about it. We think about transforming the bank, delivering our cost cap of $12 billion in 2026, and our target for ROTE that Steve was mentioning before.
Diego, can I go back to China? And you've mentioned it. Flows in and out of China account for the bulk of your activity in one way, shape or form as well. You also said that by and large, and you weren't talking about China, you were talking about broadly, that there's a benevolent loan environment or loan impairment market as well. And you also added that after the third plenum and what the PBOC did with the 10 bips, that actually things are moving in the right direction. I don't see that. I see China as incredibly under pressure. I see Chinese consumers refusing to spend money. They are holding back, and rightly so. They've had an existential shock in the property market as well. There are concerns about unemployment, concerns about youth unemployment. When I look at a lot of the flows in and out of China, I'm incredibly worried as well. And possibly many experts we get on the channel are underwhelmed by the government reaction so far. That's the counter case. Why am I wrong?
Look, first of all, we're going to have to see how they implement it. I mean, the plenum put out 60 big, broad measures. The Politburo is meeting as we speak, probably. I mean, not that they broadcast it, but we'll see exactly what measures come out of it. Again, I think it's a story of where things are happening. Yeah. We are used to things happening with us. We are used to, in a sense, north-north trade. Trade, flows of investments, everything is moving south-south. China is a super important part of that trend.
Absolutely. China is fantastically important, and I'm not trying to beat up on that. In fact, we all want to see the Chinese economy do well. My concern is that you talk about your benign and benevolent credit loan impairment side of the equation, and that's brilliant. That's kind of down to you guys in the CFO's department as well. Bill gets all the credit, but it's what you guys are up to. But the fact of the matter is, there is vast amounts of credit impairment across China at the moment on the back of a property market collapse that we are still reeling from as well, which I think the government is trying to cope with, as you say, making measures, but still trying to cope with as well. How are you protecting your impairments with that as a backdrop?
By being early. So we were early. We provisioned early, we took care of it, we ensured that we had the right collateral. As of today, while I concur with you that it's very difficult, you've asked it before on the program, to call a bottom for the China commercial real estate business, it's difficult to call that bottom, even though maybe it's a little bit more in sight than it was a few quarters ago. But the reality for us is that the issues in China commercial real estate are largely in the rearview mirror. We are 90% provisioned and covered, so that is taken care of.
Where are you finding further efficiencies in your business then? I mean, yes, you've got the fit for growth sort of plan then, and you spoke about, if that means a changing slightly job environment for a few workers, that is possible. But where exactly in the business are you then finding further efficiencies, further growth areas, for example?
A large part of it, of course, is the deployment of technology. And these days, one wouldn't expect...
That's investment as well, then, from your side, right?
There is an element. And in fact, when you think about fit for growth, we are going to realize efficiencies, but we are going to invest $1.5 billion into the business. And as a consequence, where does that investment go to? It goes in the skills of our people, and it goes in the technology that our people operate with. Within that, of course, AI these days gets disproportionate attention, although... Allow me a CFO comment. It's great to invest in a lot of things, but it's also very important that as we experiment in those 300 sandboxes that we have around the company, we maintain a clear objective of investing where it makes the most difference, which again is our cross-border CIB and our wealth management.
I'll give you another CFO comment. You love talking about jaws as well. The CFOs live by jaws as well. The increase in our expenses is less than our revenue brought in. They love that kind of stuff as well. So you must be excited about your jaws position at the moment, ex the UK banking level. And I've just read down into page 16 of your 184-page report. That's what I've been slightly distracted by. And you're saying excluding the UK banking levy. Now, we just saw the new Chancellor of Exchequer, Rachel Reeves, speaking yesterday. I interviewed her on Friday as well, and I think everybody is expecting a lot out of this government, good and bad, on the 30th of October. I can't see things getting easier for the banking sector. We've already seen a bit of a broadside at the NatWest share sale as well. What are you thinking about the UK and UK legislation that could actually potentially be negative for your sector?
So a few observations. First of all, we are very happy to be in the UK. We are a UK bank. We are headquartered here, but we are really an Asian, Middle Eastern, African bank, right? So our business is out there. But that doesn't make the question a moot point. The first signs from the government are actually all very encouraging. We'll see how they exactly develop, but there's nothing that we see that particularly worries us. The bank levy in particular, given the way it's structured, it's something that hits us in the fourth quarter of the year, and it's a very small number in the grand scheme of things. Generally speaking, optimism about the fact that there is renewed dynamism, and that ought to benefit us as a UK bank.
Yeah, and if we see stability in the gilt markets, which we saw, nice little rally last couple of weeks as well, then maybe that gives stability more broadly on the general financial sector. I've got one more question for you. It's not a CFO question. It's kind of a one that your CEO or chair, or CEO or chairman might want to answer this one. China, US as well. How concerned should we be about China, US, China, West? How concerned should we be about increased tensions? And I do notice, I think you're Italian, aren't you?
I am indeed.
Well, I noticed Mrs. Maloney there trying to smooth down the relations within the last 24 hours. But I don't think she can do much about the fact that Brussels seems on a collision course, Washington potentially on a collision course as well. Can you factor that into your provisions going forward?
So a few thoughts there. First of all, there is broad bipartisan consensus on being strong with China, both in the United States and, as you just mentioned, in Europe. So changes in the political scenery, will they really change the way that the West interacts with China? It's somewhat debatable. That is a trend that is there. From our point of view, I would go back to what I said before. China, US is less than 1% of the revenues of our corporate investment bank. What truly matters to us are the corridors that have been open for a time, that have grown, they've quadrupled in the last 15 years, and where the growth is 2 to 3 times the growth of corridors in the north, where China trades with the south of the world, trades with ASEAN, trades with India, trades with the Middle East. That is where the growth is. That's what gives us great confidence about the trajectory.
Are you pointing to a decline in the proportion of the West, that's the importance of the West then? I think you are. I think you're saying it's south-south and that's where it's at.
In the last 2 or 3 years, the percentage of flows that have been intra-Asia flows or intra-developing market flows vis-a-vis the flows that have gone to the developed markets has clearly diverged.
Diego, apologies for only getting down to actually now page 18 of your report of 184. I promise to do better next time as well. But lovely to see you. And fabulous to have you on the show. And thank you so much indeed for joining Arabile and myself. Really nice to meet you. Diego De Giorgi, who is the Group CFO of Standard Chartered. We've got 1 or 2 more guests coming.
Certainly do, quite a few, right? Because we have a flurry of earnings interviews still ahead this morning. We'll be hearing from a number of CEOs. It's the first on CNBC for a lot of those, including the chief executives of Diageo, Heidelberg Materials and Covestro, to name but a few. Do stay with us.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
Well, what do we have here? A bit of a mixed market then. Only slight gains that we saw in yesterday's trading across Wall Street then. And really a lot of it could be based on perhaps some nervousness as we head towards the Fed interest rates decision. That's anticipated to come out tomorrow. Of course, they kick off that meeting as well stateside. You also have earnings that are on as well on the calendar. Of course, you have the likes of Meta, Microsoft. Still to report then as well. Very important to see all of those. Even AMD said to put out its numbers today. So too Starbucks. I thought it was very interesting to kind of see McDonald's numbers also in yesterday's trade, seeing that fall then in a lot of its numbers and revenue, missing on the top as well as on the bottom line. Then could there be weaknesses in the consumer that we perhaps are just not seeing? Overall, though, like I said, a mixed trading day yesterday with the Dow Jones even managing to dip off in yesterday's trade overall. On the treasuries front then, well, this is what we're looking at. Longer dated treasury yields actually dip slightly ahead of the Fed's interest rate decision then tomorrow. And Wednesday, of course, you do have the jobs data as well that we're looking forward to on Friday out of the United States. So yields on the 10-year note even fell to their lowest actually since mid-July. A 10-year note now sitting at 4.182. It was even at 4.17, in fact, in yesterday's trade. Onto the Asian market picture then here. Asian markets down today. The Bank of Japan set to kick off their 2-day monetary policy meeting. Of course, the central bank is anticipated to even look to raise rates then, even if it is 10 basis points there, and trim its Japanese government bond purchases. Quite interestingly, we've just spoken to the CFO of Standard Chartered, and that share price then in Hong Kong is up now 5%, in fact. So very interesting to note that one. Steve.
Fine words out of the Italian Prime Minister, but actually, what about the action? Sam joins us now. Sam, I've watched the comments. Yes, they should work with China in the EU to lessen tensions in Lebanon, to lessen tensions in Ukraine, in Israel. But the fact of the matter is, this is the country that's pulled out of the BRI, that is part of the group that has just added a load of protectionism on Chinese EV goods coming into the EU as well. The words, I get it, it's very moderating, it's very calm, but what about action?
That's exactly what China wants to see, because what we're seeing here is certainly positive with regards to reassurances from both these leaders that they still view the relationship as something that they both value despite their differences. I think that's the takeaway from the discussions we're seeing. But China, while it does sort of like the approach that Italy is taking here by actually making this pilgrimage to Beijing, shaking President Xi Jinping's hand and, having all this dialogue, they want sincerity in these negotiations, because arguably they feel like they've been burned before. They've had a number of US officials come to Beijing as well and sort of talk the talk, but they want to see them walk the talk as well. So I think the big win for China from this seems to be that if they can try to convince Meloni and Italy and these officials and perhaps some of these companies as well to maybe change their tune when it comes to supporting the tariffs on the Chinese EVs, because they really need the votes here, because we know that these are just provisional tariffs for now. They officially will kick in at the end of the year. So that would certainly be seen as a good thing for China and would be really the barometer of success of this meeting. The other thing that China seems to be doing is having a bit of a subtle dig through these meetings at countries that aren't really taking the same approach as the Melonis and the Orbans of the world. And that is because if you read the Xinhua readout from what President Xi Jinping has actually said, he said that there's basically two ways of doing this. You've got countries that will either progress together through connectivity and unity, or you have countries that will retreat separately through closure and division. So that seems to be perhaps a message for the countries that are doing the latter, as they do sort of see what Meloni is doing as a model for perhaps other countries to follow suit.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.